Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the Econ Show, we're going to cover a decent amount on new Fed data that's come out, and it comes out across the U.S. in terms of impacts on prices paid, prices received. So the way that we're going to break this up, in segment one, we're going to look at what is happening with monetary policy, more specifically within the U.S., and how is that driving things going forward. Then in the next segment, we're going to segment two, we're really going to look at where are prices. Have consumers seen the last surge? Is there more behind it? What does that look like going forward? Then in the third segment, we're going to talk about housing. Now that a lot of real estate data has come out, housing data has come out, have we hit a peak? Is this going to be a slowdown? What is this summer really going to look like? Then when we turn to Europe, we want to say, what happens post-COVID? We know that they're starting to reopen, but what are some permanent changes, or what are some shifts that we should expect coming out of Europe? Then when we turn to Asia, we're going to go through some recent data points on an economic level, but realistically also dig into the debt side. How much debt overhang remains, not so much around the rest of the Asia, but more so in China. And then we're going to look at trade data and how trade has really shifted over the last 3 years. That's just kind of weighing in on Chinese growth. So last recap on this, one of the things as the ceasefire continues to hold, this is just highlighting kind of where a lot of the strikes from Israel really were laid down. And you could see that, we talked about it. There were 4 stages, stage A through D, in terms of taking out some strategic strongholds of Hamas throughout the region, especially when you look at this red area where a lot of those strikes took place. That was a large part of what they called the Gaza Metro, or the entry points, exit points, storage points along this underground tunnel network. So now the next question of the ceasefire, which was brokered by Egypt, so far has been holding. Each side claims victory. Then getting back to building, because the last time Hamas was left in charge of building, a lot of the money and a lot of the equipment that they were given went to building a lot of these tunnel networks. So the question will be, is there some sort of joint coalition that makes sure that this money is being spent on the people that need it? There were hospitals that were destroyed. There were other, strategic residential and really non-lethal things that need to be rebuilt. And we want to do something that, hopefully is a little bit more sustainable. But just given the hatred on both sides at the ground level, it's going to be difficult to see where, does this stop things for now? Yes. Does it solve any of the problems? No. And that's where the biggest issue is going to reside as we continue to see what the next few years play out with, as we do have a lot of nationalism, a lot of xenophobia around the world. This is not a comment on just Gaza and Israel, but just when you look around the world, there is a significant amount of pressure mounting that is going to become a much bigger issue over time. So then when you think about pressure, uncertainty, movements, that's when you can start to look towards, well, what is the risk in the market telling us? And even though we've had rates start to come off a bit, you've had a decent bid in bonds, especially in the U.S. over the last few sessions, we're still not seeing a big correction down in the MOVE index. And this is just looking at how much volatility is there in the underlying bonds. And this is always coming down to, well, what about inflation versus economic growth versus the amount of debt that's being purchased. We've had several fairly strong auctions out of the U.S., which has been supportive of some of the volatility, just because they've gone off fairly well. There's not too much risk. The market has gotten back into its very steady uptrend, which has pulled down the VIX overall. But the bond elevation, I think, is the biggest concern right now, especially when you turn over and you look at what is happening with the RRP or the reverse repo purchases, which we'll talk about in greater detail in a few minutes, because it's important to understand just how much liquidity is sitting at the bank level. And that's one of the biggest issues when we start talking about, well, when does tapering make sense? When does that come out of? And they're no longer talking about tapering, but they're actually going to discuss when tapering will take place and give some sort of clarity as to what does that look like. And now, even though we've had inflation fears back off, you've seen China has come out aggressively in terms of trying to manage some of this commodity price, and we've seen some of these commodity prices come down. Here's where you can see a very interesting backdrop where, yes, you've had some break evens normalize. As my old boss used to say, nothing goes up or down in a straight line unless you're the S&P 500, which then does. But when you look at just, when things are going up or things are going down, nothing dies in a straight line. You have plateaus, you have pivot points. So here's just one of those ones where we've seen a pause in terms of some of these movements. And I do think that they will continue, and we'll talk about where we are in the inflation cycle. And the thing is, like when we look at inflation, we've been talking about it aggressively since last year, saying like, look, this is coming. We were told we were crazy, but here it is. Now that everyone's talking about inflation, it's important to say, okay, well, what comes next? Do we have continuous inflation? Do we have stagflation? Do we have deflation? One of the things, I'm not famous, but one of the things that I've been saying a lot of is the 2020s are going to be a weird amalgamation of the 1930s and the 1970s. And we're going to have these pressure points throughout that period as monetary policy is going to, as I want to say, naturally come to an end, but will have to be pared back due to inflationary fears, liquidity that's just saturating the market. But then you have the fiscal response because what happened in the 1930s, especially in the U.S., you had a very large fiscal response. So what did that do on the inflationary level? Because in 1930s you had deflation, but right now we have not 1970 style, but you have inflationary at the same time you're mounting more and more fiscal policy. So we have the easiest monetary policy ever in the history of the Fed mixed with the easiest or most fiscal response ever in the history of fiscal responses. So at what point do you have to yield on one side? And I'm not saying that you have to yield on both, but something's going to have to give. And at this point, I'm going to say that it's going to be closer to the monetary policy just because the saturation point is just reaching a fever pitch, which we'll talk about in a minute. And when we look at what is driving the rally in commodity prices, because everyone keeps talking about this mantra, and I think Bjorn does a very good job. He's on the Bloomberg economics team. That's his Twitter handle at the bottom. So when you look at what has happened so far, and this is, I think, an interesting calculation that we've been talking about a great deal, the anticipation of new demand outpaced actual demand. And given that we're talking about futures market, we're talking about commodity pricing, so this naturally happens. People run up ahead of it. But at what point do we get to a period of, look, we had supply. We know that there were supply disruptions. Supply disruptions were there. Demand has been fairly strong depending on where you are. Now you look at China and they actually have a lot of steel in inventory. They now have a big pressure in terms of, okay, well, how are they going to get through all of this product? Which is why they're trying to pare back some of this buying power. But the risk appetite or the view that you were going to get this surge in demand has now reached that fever pitch. And at what point do we start to see some of this come out? I mean, we saw it happen in corn. We saw it happen in some of the grains. We've seen it happen in lumber now with several limit downs. Crude has essentially just gone sideways at this point, but it never really went with where iron ore, copper, tin, a lot of these other commodities have really gone. And I think this is going to be that piece of, where does the speculation come out? And China has increased leverage ratios that are necessary. They've tried to adjust some of the leverage ratios. We've seen that in the US. We've seen that in other areas, trying to pull back on the speculation because it's gotten things ahead of itself. Now, for those that have ever traded corn, like myself, I'm old enough to remember when China bought all this corn, everything went parabolic. And then afterwards, when the price ran up and they realized what they bought it at, they're like, oh, yeah, GMO. We can't do it because of GMO. Now they're backing out of some of their recent purchases. Not a lot, not all of them. They're still buying a record amount of corn, but they're starting to pare back a bit, which again speaks to some of this speculation overall. Now, because it's relevant when we talk about fiscal and monetary, what happens with robots? What happens with investment at the economic level when you think about corporations? And as you see an increase in robot adoption, you also see an increase in inequality. And the reason why is the robot is typically displacing the less skilled laborer. So you're going to need a more skilled laborer, or you're going to, or if you want to call it white collar, but even the white collar side is getting replaced more and more by robots. So it's the speed at which it's adopted. And I think 2020, when you look at the amount of money that was pushed in, you're seeing more, what's the best way to put it? You're seeing less people get hired back. And we've talked about the amount of IT spending that has happened, the amount of automation that has already happened and has been happening, but it just accelerated through 2020. This is where we start to see the pressure on jobs. When do jobs come back? What type of jobs come back? What kind of skill of those jobs come back? And this leads to, because you can't do that job anymore because that's a robot does that now. And that's where we have to look at where is this going to put us, and does this make the inequality problem bigger at a grander scale across the world? Because it's not just going to be the U.S. It's not just going to be the U.S. that is investing in robots. Samsung building a facility in Vietnam is going to have more robots. More automation is going to be natural, which is going to displace people and displace the lower quartile, which again leads to spending. Where are people going to get money? How are they going to get training? And this, I think, leads to that drive for more unrest, more social discourse, which I think we're starting to see, continue to rise up. Now, while all of this is happening, when you look at the increasing headwinds, now this is coming from Robin at IIF, when you look at the increasing headwinds for emerging markets, you're seeing those flows. And as rates have been sticky, even though you've had a correction in rates, especially in the US with the 10-year kind of setting the stage, you're still seeing this pressure where emerging markets, that disconnect on the GDP level is giving people pause. Like, well, do I really want to invest in emerging markets if I see the breakdown, if they're slow to get vaccines, if there's going to be a potential for a resurgence of COVID, whether it's a different variant or the same? How do you try to mitigate against these risks? And that's why I think even though you're getting a pause in yield, it doesn't mean that the yield is going to stop, and that's going to push us back up, and you're going to see this pressure, which again is going to put emerging market equities and bonds in particular under pressure. Now, while all of this is happening, we talk about supply chains, and we're going to talk about it more in the last segment. You just want to look at what happened with automakers, because lost production, Fitch has estimated that 3.8 million units won't be in the world, because there's semiconductor shortages, there's pressure across the world, across the really everywhere when you think about the creation of cars, which is going to pull more of this capacity out of the system. Now, used cars are at record prices, new cars are at record prices, and this losing 3.8 million units for a year is going to keep those prices elevated. I'm not saying it's going to keep them at the levels that they are, but we're not going to see the same type of reduction until we start to get some sort of normalcy back into the production units. And that's going to be difficult because when you start looking at, the top producers in the top countries of extraction. So when we look at, and this comes to when you think about rare earths and renewables and where do you get your renewables? Well, the extraction side, is pretty clear as to where it comes down to, but processing. Where is this being processed? So even if China doesn't own the minerals like they do or control the supply chain like they do on rare earths, they're the leader in processing, which is a dirty, disgusting business, which is why we've exported it. We don't do a lot of that here. And this is where they continue to, even if they're not controlling the mine, they still control one of the most important parts of the supply chain, the processing side. And then they export it as a semi-finished good or a finished good. And that's where they continue to insert themselves in a very aggressive way. So by them talking about slowing or reducing their monetary policy as they've tightened credit ratings, they've cut credit impulses. That's why it's so important when you consider about China and the speculation in the commodity markets as to if they start to slow and put pressure on it, well, how much of that speculation comes out? But where is the fiscal stimulus? Because when you look at just where the fiscal stimulus has been driven, it's the U.S., especially when you look from September of 2020 to March 2021. This is the percentage of GDP that has been added on top of what was already done last year in the peak of COVID lockdowns and reductions. Now you can see many other countries have been very slow to add on to a lot of this capacity, where in the U.S. there has been little to no hesitation on adding on to this stimulus. So that now when I talk about China slowing down, cutting credit impulses, cutting monetary policy, yes, the U.S. is doing more, but it's also being spread out, because when you look at the infrastructure bill, that is going to be spent over 8 years. So you're not going to see all of a sudden everybody coming out and just dumping into copper like actually China did do. It's going to be spaced out. And we're also getting adjustments. Now they're saying that they're going to cut back on subsidies on EVs and the underlying EV infrastructure, which will cut copper and try to put it into some other areas, which again is going to be some of the bigger drivers overall. And that's when we turn to, well, if you have all that fiscal stimulus, how can you keep putting so much money into the system? And that's when we turn to the RRP, or the reserve repo purchases. So the most recent number that came out was $450 billion. And what is a deposit to a bank or a financial institution? It's a liability because they have to pay it back. If I give Citibank my money, I want to make sure that I get it back. If I give Wells Fargo my money, I want to make sure I want it back. I won't want it back all at once, but I'll want it back in general. So that's when you start looking at the loan to deposit ratio, because typically banks will take $1 from you and then invest 80 cents of it, whether that's in a loan, that could be a mortgage, some sort of bonding, but they're going to put it back into circulation. Now, as their levels increase, they don't have the capacity to do that. They're just too much liquidity and not enough either good opportunities or opportunities in general to reinvest that capital. So they are sitting on it. Now, they typically put it and they trade it around the banks, because then, for an example, JP Morgan might be short, $5 billion and Citibank is long 10. Well, they'll do a reverse repo agreement, and they'll say like, look, I'll lend it to you overnight, pay me a nominal rate, and you'll get it back. It's because every bank is sitting in the same situation. The Fed has opened up what is the RRP, and they've removed the cap. And the cap is typically in place because banks can't use beyond a certain level. But because there's so much, they've removed that cap. And now you're getting banks putting more and more. Now the RRP is a short-term removal of liquidity. It can range from overnight or to term. So the term is the Fed window, and the bank or financial institution comes to an agreement on maturity and price. It's typically a short term measured in 366 days. So you're just taking liquidity out temporarily, not permanently. And you're just hoping that some of this works its way through. But when you look at just where we are in the historical trend, we're already at places where you started to see the commentary on tapering. And a lot of times the size that we're seeing happens much closer to quarter end, a month end and quarter end versus right now. So again, these are the pressures that we're seeing. There's no way that they're not looking at this and saying, oh, we're going to have to address this. And this is where tapering and that commentary starts to come in. Now, this just shows you how bad the loan to deposit ratio is. So all you're doing is you're dividing total deposits by total loans. So you're just trying to get to a percentage of, how many loans are really at that level. Like what is the overall capacity in terms of just lending this out? So when this is the problem. So you're seeing this loans and leases just moving to this all-time low. And this is just saying that for every dollar the bank takes in, they lent out 60 cents. And and it's not because, it's a mixture of both, where there's just the returns aren't there, rates are too low, but there's also so much in deposits. Because what are deposits? They're just, money market accounts, savings accounts that are coming to the bank. What have people received? People have received their tax refund, their stimulus, and they're not spending as much, so they're saving more. Corporations haven't hired back as many people, have talked about investing more on CapEx, but have been hesitant to do so. So there's more money in their money market accounts. So you're getting this surge in deposits from getting transferred to the bank, and then the bank is like, guys, I have nowhere to put this, because the loan to deposit ratio, because the loans divided by these deposits, it's just not there. And that's where we continue to see this overwhelming amount that has to get placed back at the bank. But that's, how do you stop that? Well, this is typically where you start to say, look, tapering has to really come back into the lexicon. But we're still seeing the Fed expand its balance sheet. And this just shows you that the liquidity has now saturated all the way through, and we need to see some sort of adjustment. And that's when you start to say, well, as the levels start to increase, what does this mean for foreign reserves? The US dollar has been the reserve currency, du jour over the last, essentially 50 years. But what is that? What has been happening? And when you look at the official foreign exchange allocated, the U.S. dollar is still there. Like as we said in our U.S. dollar show on our channel, it's still there. It's just it's getting smaller, and it's still over 60%. Like when you look at it in general, it's about 68% is sitting there as our reserve. But countries are utilizing other. They're starting to use other currencies, replacing it a bit, using more physical in terms of gold, or going as far as talking about potentially crypto or some sort of digital currency backing. Now, all of this is happening, and this updates tomorrow, because the RRP is happening at the SOMO, or when you think about what is those total SOMO holdings, you can see just the level amount that is being transacted, because the bank is giving you the bank is getting something from the Fed to show the cash, and it's typically something that's on their sheets. So it's not a naked transaction, but it's just going to come back and expire, which again is putting that pressure on the liquidity that's just going to remain over the longer term. And all of this is happening as pressure remains throughout the system, because you have these fears and the saturation. All the while you have supplier delivery times The longer delivery times coming in, you continue to see these huge disruptions that are not clearing themselves. They're actually getting worse, and that's something that we're going to talk about specifically in segment 2. And when you just look at the measures of it all, when you talk about the workers, how is this impacting work? And the firm's finding it hard. So technically, when you look at the US, you would say that it's actually a tight labor market, but it's not acting like that. And that's where we're going to talk about the separation between skills and hiring and just where labor is and where wages are. And some of this data that is contradictory, and how do we start to see this materialize as the Eurozone, Japan, UK continue to see a lot of this softness, not only in just the labor shortage overall or lack of labor shortage, but also in hours worked, because hours worked have been under pressure in Japan, Euro, and the UK, where average hours worked are getting better because people in the U.S. are working more hours, but there's less employees working those hours, and that's kind of this conflict that we continue to see on just where does labor sit versus wages as prices continue to trend higher for the consumer overall.